Simeon, we were just talking about how the retail investor has lagged the S&P 500, and I'm curious because there are so many ETFs at ProShares, and some of them levered and some of them not. How is the institutional investor potentially beating indices and the retail investor is lagging? What are they doing wrong?
Well, I think the way we're characterizing rolling into 2025 is rational exuberance. And what some folks are missing, and if they're missing, they might be missing out on the market because they're nervous, is some fundamental changes behind the profitability of the stock market. And it comes down to the following surprise. There is a lot less leverage in the stock market than there was just 20 years ago. So there is 1/3 net debt to EBITDA is the classic measure. We're from 5, we're down to like 1.25. There's a lot less leverage. Now, that means less risk. But what it also tells you is it uncovers very strong underlying profitability. People focus on return on earnings. Return on earnings isn't much higher than it was 20 years ago. But when they're achieved with 1/3 of the leverage, that means that the underlying return on assets, the underlying profitability of the S&P 500 is 4x what it was 20 years ago. So I think if you're not fully cognizant of that piece, you're looking at the market and you're saying, I can't go there. But we'll call it rational exuberance, and I think that's the missing piece that some people haven't gotten their arms around. The fact that in some ways, even at 25 times, the market may not be as expensive as the casual observer may think.
So if you're saying the S&P 500 has about a third of the leverage that it had 20 years ago, where has that gone? Where is that just, risk appetite that went away, or has it moved somewhere?
People like to talk about the private credit market, and that's the kind of standard answer. But it does have, at least with respect to the S&P 500, it does have something to do with the technology sector and communication services that are just generating cash like crazy. There is a very strong cash generation aspect to the S&P 500. Yes, there's private credit out there, but with regards to large cap stocks, the leverage really has been mitigated by that incredibly strong cash flow. But what I would note is even the public credit markets are priced to perfection. If you look at the high yield spreads today over treasuries, they're less than 300 basis points, less than 3%. Historically, the average is 6. Now, when you got that average of 6, you on average lost 3% to default, so you netted 3%. That means today in the high yield bond market, if there are 0 defaults in the public high yield market, you will get less spread than on average over time net of defaults. So that's why another reason why we think risk is better taken in equities where you have upside, where the public debt market is priced to perfection.
When you think about next year, a lot of conversations are brewing about the value of diversification when the last couple of years, if you just put money in the S&P 500, you might have been better off. And a lot of people who could have captured some of that extra yield in fixed income markets sat in cash and were also just better off than maybe taking on either duration or credit risk. How do you think about this dynamic heading into next year? Do you play caution with some cash markets here, or do you find that extra way to pick out yield that's outside of the obvious?
It's a challenge because on the long end of the curve, which I would argue has been behaving rationally, Chair Powell said 2.5% inflation, not 2, and we've gone from 4.1% to 4.6 on the 10 years. So it's behaving normally, but there is risk of inflation on the long end, and that means yield up, price down. And of course, there's still some cuts to Fed funds, maybe just one more, but look, that's a salary cut for folks in those money market funds. So, and you also have the tight spreads we talked about. That does leave the income-oriented investor in a quandary, to which we think it is a good idea to look towards equity to fill some of those income needs. The problem is that some of the classic ways to do that, high-yielding stocks like REITs and utilities, they can just be kind of bonds in disguise, and they might be interest rate sensitive as well. So we're appreciative of, for example, the explosion in the covered call space to generate income that's not interest rate sensitive. And here we note for folks the S&P 500 Daily Covered Call Index, which brings daily options into play. And that's a nice way for folks to get some income that's not interest rate sensitive and keep exposure to the equity market, which, hey, yes, you gotta hold your nose a little bit, but we think it has better opportunity than the credit and the fixed income side.